I just finished reading the most highly rated investing book on all of Goodreads. And after reading this book, which was written by Pulak Prasad, I understand why so many people love it, as it either shifted or reinforced the most important investing lessons I've ever learned. Now, in this video, I'm going to pull out the 10 most important investing lessons from this book, starting with lesson number 1, which is about the importance of survivability. Now, Prasad points out that in nature, survival is the number one most important thing for any animal or even species. Now, in nature, this means that species have to adapt to survive their changing environments. If they don't, they perish. Well, Prasad points out that this fundamental principle should also be your number one most important goal as an investor as well. This means that investors should first and foremost focus on avoiding situations that can result in a life-changing loss instead of focusing on maximizing their upside. This means they should avoid taking excess risk or using financial leverage, which can result in financial ruin. That brings us to lesson number 2 about the book, which is the importance of investing in quality investments. Now, you've probably heard Darwin's term about survival of the fittest, which refers to the idea that individuals that are best adapted to their surroundings are the ones that are most successful in surviving and reproducing. Well, Prasad points out that investing is all about buying the fittest companies. Now, to Prasad, this means investing in quality companies which have the most robust fundamentals and the strongest sustainable advantages, which will allow them to survive over the long term. Now, in the book, he points out that there's 2 factors that he emphasizes above all. The first is something called consistently high return on capital employed. This is a ratio that measures how much profits a company generates in relation to the assets that it has deployed in the business. And he points out that companies that have a consistently high return on capital employed over a long period of time indicates that the underlying business is high quality because it must be taking advantage of a strong competitive advantage, effective capital allocation, and have generally good management in place. The second concept that he looks for in a quality business is predictability. He says that focusing on stable, boring industries like electronic components or sanitary ware, where the winners and losers are well established, is more successful strategy than chasing volatile, fast-changing industries like biotech or e-commerce companies. That brings us to the third key takeaway from this book, which is the importance of being lazy. Now, Prasad points to the incredibly slow and steady process of evolution in nature. It can often take a long time or even multiple generations to notice that anything at all is happening. Prasad points out that investors should act in a similar manner with their investments, and that being lazy allows them to take advantage of the full power of compounding. Prasad points out that actual wealth creation is a slow process that requires lots of patience and laziness on part of the investor. And the key is to stay invested in very high quality businesses for a long period of time is the only way to allow compounding to do its magic. This means that investors should often focus their attention away from short-term market noise, such as news and headlines that could tempt you to make short-term decisions. So instead of focusing on the news of the day, Prasad recommends focusing your attention on the company's underlying fundamentals, which will help you stay focused on the factors that actually drive long-term performance. As an aside, I made a few visual summaries of the most popular investing books of all time, including this one, and I compiled them into a free ebook. If you want a copy of that ebook, just visit longtermmindset.co/10 ebooks or click the link in the video description and let me know where to send it. Now that brings us to the fourth big lesson of this book, which is to look for costly signals. Now, in nature, animals often display signals that are often very difficult or costly for them to produce. And Prasad points out that the more costly a signal is to produce, the more likely it is for that to be an honest signal. Now, a great example of this in nature is to look at a peacock's elaborate tail. Only a very strong and healthy peacock can afford to grow and maintain such a large and colorful display. And that produces a strong signal about its genetic fitness to potential mates that are out there. Now, in nature, the more costly a signal is to make, the less likely it is to be fake, and the more reliably it conveys information about that individual's quality or condition to others. Now, this same concept should apply to investing as well. Investors should pay very close attention to the most costly signals that there are for companies to produce. Now, for example, take a company like Coca-Cola, which has a decades-long track record of consistent financial performance and making dividend payments to its investors. That's a very costly signal for it to produce, so investors should place a lot of trust in the quality of that that signal. Now, by contrast, this means that you should be very wary of signals that are cheap or easy to produce. For example, an optimistic press release or a flashy presentation. Since these signals cost next to nothing to produce, you shouldn't put any emphasis on them. Instead, you should focus your time on real signals from real businesses as a way to identify the quality ones. Now, the fifth principle here is the importance of exploiting punctuation events, as Prasad calls them. Now, in nature, the theory of a punctuated equilibrium suggests that species often experience long periods of relative stability, or stasis, where very little change occurs. But these calm periods are then punctuated by rare, rapid bursts of dramatic change, and they are often triggered by significant environmental shifts. Think of the effects of an earthquake or a forest fire or even the meteor striking Earth. These events create instability, which open up opportunities for animal species to create new niches to go into and thrive. Well, the same thing is true of the investing world. Now, during these chaotic events, such as economic crises or market panics, investors can seize opportunities to buy high-quality businesses at attractive valuations. Those businesses can often not be purchased during periods of stasis because the markets are acting normally and pricing those businesses well. Now, while these events are rare, investors should keep an eye out for them as unique times to make huge sums of money in relatively short periods of time. That brings us to principle number 6 of the book, which is the importance of studying history. Now, in nature, studying history means analyzing the past and not focusing any time at all trying to predict the future. This is because the past provides a much better indicator of an animal's success instead of a complex forecast which looks forward. Prasad points out that by studying historical patterns and comparing species across different environments, it's easier to identify commonalities in survival and extinction rather than treating each species as a unique case. Prasad contends that studying the past is a much better predictor of success than looking ahead and making predictions about the future based on complex financial forecasts. This is why Prasad only uses historical information to make valuation decisions on businesses and outright ignores all analyst projections and future forecasts about what a company is expected to do in the future. Prasad points out that historical data that is actually accurate and correct is far more useful than forecasting future data, which is inaccurate at best. That brings us to lesson number 7 of the book, which is about the importance of looking for competitive advantage. Now, in nature, certain physical features like a mountain range or a deep river can protect species from predators or competitive threats in the world. These physical features can allow a species to survive and thrive for a far longer period of time than if they weren't there in the first place. Prasad points out that the same concept can apply to businesses, and it's your job as an investor to look for these natural barriers that protect companies' profits. These could be things like a strong brand, a patent, a unique technology, or a cost advantage. Any barrier that makes it very difficult or hard for a rival to enter the market and steal market share, which protects the company's long-term profitability and prospects. Borrowing this lesson from nature is an important reminder about the importance of finding companies that have some sort of competitive advantage that protects their profits from the forces of capitalism. Now, lesson number 8 from this book is about the power of compounding, which this book frames as the investor's natural selection. Prasad points out that in nature, it's often a small advantage that is consistently applied over a long period of time that leads to significant evolutionary changes. And Prasad points out that compounding and investing works in the exact same way. It's the process where your investment earnings are continually reinvested, and then those profits are then reinvested again to earn more and more earnings over time. By taking advantage of the power of compounding in the market, you give your portfolio the chance of exhibiting the snowball effect, where your wealth grows exponentially over time. And this lesson highlights the importance of starting very early, being consistent with your investments, and letting the magic of compounding do the hard work for you. Prasad points out that it's not about focusing on get rich quick. It's all about allowing the natural selection of growth that happens to a portfolio exhibit itself over the long haul. Now, lesson number 9 from the book is about the importance of studying cycles. In nature, there are cycles everywhere, and they are absolutely fundamental to allowing ecosystems to function properly. Seasons change, which bring periods of growth and abundance, like spring and summer, and they're followed by periods of dormancy and scarcity, such as autumn and winter. The same can be true of the tides, which predictably rise and fall and have big influences on coastal life. Ecosystems themselves experience cycles of growth, maturity, and even contraction and renewal. Now, these natural rhythms are not linear, but they are cyclical in nature, and they're constantly repeating and influences the organisms within them. The same exact thing can be said of markets. Markets go through elongated periods of growth, which are called bull markets, and eventually they go through shorter periods of decline, which are called bear markets. Economic expansions are often followed by recessions, and industries evolve in cycles of innovation, maturity, and death. The book points out that we shouldn't fixate on short-term fluctuations, but we should rather zoom out and understand larger market cycles. And recognizing that markets have rhythms to them can help us maintain perspective during downturns and avoid getting overly euphoric during market upturns. By studying the natural cycles of the market, we can make better long-term decisions and position ourselves for long-term success. Finally, Lesson 10 brings us to the absolute necessity of thinking long-term, a reinforcing theme that runs throughout the book and in nature itself. So in nature, playing the long game is evident by the incredibly slow and steady process of evolution and ecological development. Building anything of significant size and scale, such as an ecosystem, coral reef, or forest, is a slow process that requires years upon years to actually play out. So this book powerfully illustrates that by adopting a long-term perspective and focusing on the underlying quality and adaptability of your investments, you're allowing the natural forces of compounding and growth to work over decades. And you're aligning yourself with most successful strategies in both the natural world and the investing world. Well, I hope that you enjoyed this review. I think that this was an absolutely fabulous book and it was a joy to read, and I do plan on rereading it again. And as a reminder, if you want a visual summary of this book and 10 of the most popular investing books of all time, just visit longtermmindset.co/10books or click the link in the video description and I'll send you a copy right away. Well, thanks for watching this video. I hope you enjoyed it. Wishing you investing success.